Every year, thousands of high earners pay underpayment penalties, not because they didn't have the money, but because no one helped them build a system around their income. If you have multiple income streams like salary, bonus, equity comp, and investments, you might be at risk. And this mistake almost always comes down to one thing. It's not really a tax problem, it's a timing problem most people don't even realize they have. In this video, I'm going to show you how to actually avoid underpayment penalties, step by step, especially if you have multiple income sources like bonuses, RSUs, or investment income. We'll break down how your tax bill is really calculated, why high income earners like you are most likely to get this wrong without even realizing it, and how to know before the year's end whether you're on track or heading towards a penalty. Let's start here. Think about how your income actually shows up throughout the year. Part of it is steady, that's your salary. But then you have spikes. A bonus might hit in Q4. RSUs vest each quarter. Maybe you sell stock, which then creates investment income and capital gains. Your income doesn't come in like a smooth paycheck. It comes in waves. But the problem is the IRS doesn't see it that way. They assume your income is earned evenly, month by month, across the entire year. So now you've got a mismatch. Money is coming in unevenly, but the system expects your taxes to be paid as if it was perfectly smooth. And that gap between how you actually earn and how the IRS expects you to pay is where underpayment penalties start to show up. You need to understand how your tax bill is actually calculated. If you're like most people, you probably think your taxes are settled at the end of the year. You file in April, you pay what you owe, and that's the moment everything gets finalized. But that's not actually how the system works. Your total tax bill is based on everything coming into your household. Your W-2 income, your bonus, your equity compensation, investment income, and if you're married, your spouse's income as well. All of that gets added together to determine what you owe for the year. But here's where people get tripped up. The IRS doesn't care about the total number at the end. They expect to be paid throughout the year as the income is earned. This is called a pay-as-you-go system. So they're effectively tracking, did you pay enough and did you pay it on time? Because you can do everything right in April, pay your full tax bill, or even get a refund and still get hit with a penalty. Not because you didn't pay, but because you didn't pay it when the system expected you to. If you're like most high earners, you're probably assuming your taxes are mostly handled automatically. You've got withholdings coming out of your paycheck. Your bonus gets taxed when it hits. Your RSUs vest and taxes are taken out there too. So on the surface, it feels like everything is being taken care of. But here's where the problem starts. A lot of your income, especially bonuses and RSUs, is withheld at a flat 22% rate. But if you're a high earner, you're not taxed at 22%. You're more likely in the 32%, 35%, even the 37% range. Without realizing it, every time one of those events happen, you're falling a little bit short. Let me give you a simple example. Let's say you have $200,000 of RSUs vest. About $44,000 get withheld for taxes, but your actual tax bill on that income might be closer to $70,000. Now that's a $26,000 gap just from one single event. And the tricky part, nothing looks obviously wrong when it happens. Your pay stub looks normal. Taxes were taken out. Everything feels like it's working. But underneath the surface, the gap is building. And if this is happening across your bonus, your equity, and maybe even investments, it starts to stack. If you look at any one of these events on its own, it doesn't seem like a big deal. A little under withholding on your bonus, a small gap on your RSUs, maybe some investment income that didn't have any withholdings at all. Individually, each one feels manageable or easy to ignore. But this is where the real problem starts, because it's usually not one thing that causes the penalty. It's multiple things that are just slightly off. Your bonus is a little short, your RSUs are a little short, your investments weren't accounted for at all. And over time, these small gaps start stacking on top of each other. So by the time you get to the end of the year, you're not just a little off, you're meaningfully behind on what the IRS expected you to have paid throughout the year. Here's where this really starts to matter, because this isn't something that just gets calculated once at the end of the year. The IRS is effectively checking on your payments throughout the year. They're looking at each period and asking, did you pay enough during this window? And if the answer is no, that's where the penalty starts. So even if you catch up later, maybe you realize you're behind and make a large payment towards the end of the year, that doesn't fully fix the problem, because the system doesn't just look at where you ended, it looks at the gaps all along the way. Even more importantly, when you do make a payment, the IRS doesn't apply it however you want. They apply it to the oldest underpayment first. So one missed period early in the year can continue creating issues, even if later payments are large. Another small detail that trips people up is these quarters aren't evenly spaced. April, June, September, January. So it's actually easier than you think to fall behind without realizing it. At this point, you might be thinking, okay, so how do I make sure I don't get penalized? And this is where the safe harbor rule comes in. And it's one of the simplest ways to protect yourself. If you pay at least 90% of what you owe for the current year, or 100% of what you owed last year, 110% if your adjusted gross income is over $150,000, you can avoid the underpayment penalty. So even if you end up owing more when you file, as long as you hit one of those thresholds, you're generally protected. But here's the important part. This is where a lot of people stop. They hear safe harbor and they think, perfect, I'm covered. But this isn't really a strategy. It's just a minimum requirement to avoid a penalty. It doesn't mean your taxes are optimized. It doesn't mean you won't owe a large amount at the end of the year. It just means you avoided the penalty. So think of safe harbor as your safety net, not a full plan. Once you understand all of this, the next question becomes, how do you actually fix it? Most people assume the answer is simple. They think, I'll just make an estimated tax payment, and that can help. But there's a better option, and this is where understanding how the system really works starts to pay off. Because not all payments are treated the same. Estimated tax payments are counted when you make them. So if you're behind and you make a payment late in the year, it only helps from that point forward. It doesn't fix the earlier gaps. But withholding works differently. Withholding is treated as if it was paid evenly throughout the entire year, no matter when it actually happened. So if you increase your withholding later in the year, it's almost like going back in time and filling in those earlier gaps. That's the opportunity. If you realize you're behind in Q3 or Q4, you don't necessarily have to scramble with estimated payments. You can adjust your withholding through your paycheck, your bonuses, even equity events, and effectively clean up the issue retroactively. This is one of the biggest areas we help clients with, building a system where this is monitored and adjusted throughout the year. So you're not trying to figure this out at the last minute. There's actually a way to align your tax payments with when your income really shows up. So instead of being penalized for a big spike in income, you can match your payments to that timing. Keep in mind, the IRS doesn't make this obvious, and it's a little more involved to do correctly. So most people never use it. But conceptually, this is what matters. If your income is uneven, your tax strategy should be too. Because when your payments better reflect reality, you reduce the chances of those gaps forming in the first place. And this becomes especially important if large portions of your income come from equity or variable compensation. When you zoom out, avoiding underpayment penalties really comes down to having a system, not guessing, not reacting at the end of the year, but a system where you understand your full income picture, you project your tax liability, and then you monitor it throughout the year. So when something changes, a large bonus, a bigger RSU vest, or an equity event, you're not caught off guard. You adjust. And most importantly, you're using the right levers. Not just making random estimated payments and hoping it works out, but intentionally using withholdings and timing to stay on track. Because once you understand how the system works, this becomes very predictable. If you want to avoid this going forward, here's the shift. You're not only getting penalized because you didn't pay enough. You're getting penalized because the timing of your payments doesn't match how your income shows up. And for most high earners, this mismatch is built into how you get paid, which means this isn't about working harder or paying more attention at tax time. It's about having a plan that's built around your actual income, not the IRS's assumption. Now, if a big part of your income comes from equity, like RSUs, stock options, and ESPPs, this gets even more important because those are some of the biggest drivers of both tax surprises and underpayment issues. If you want to understand exactly how those are taxed and how to avoid getting hit with unexpected tax bills in the first place, click right here to watch the next video on avoiding surprise taxes on your company stock.